Good morning, everyone. Today I want to talk about the risk of a conflict between the United States and Venezuela and what it means for financial markets. So I'll keep this short and sweet. So the risk of conflict is driven by two things. First, the increased U.S. military presence in the Caribbean as part of its war on drugs. And secondly, Venezuela's decision to mobilize its militias in response to what it sees as an invasion. Now, the probability of a full-scale war is still low, maybe 20–30%. But even that risk is enough to send shockwaves through financial markets. The biggest impact will be on energy markets. Venezuela has some of the largest oil reserves in the world. But due to sanctions, its production is already down to around 800,000 barrels per day. A conflict or tighter sanctions could easily disrupt this, sending Brent crude prices up by 10–20%. This will increase transportation costs, hit logistics companies, airlines, and ultimately consumer prices around the world and fuel inflation. In the short term, we could see a risk-off sentiment drive. A 5–10% pullback in equity markets with the S&P 500 leading the way. Gold and U.S. Treasuries should rally as investors seek safety. Emerging markets, particularly in Latin America, could come under pressure as well as global trade routes. If tensions in the Caribbean escalate, insurance costs will rise. But here's the good news. Currently, the S&P 500 is near all-time highs, and markets are pricing in a lot of good news. A conflict would cause a temporary shock, not a permanent crisis, unless, of course, it escalates significantly. So keep an eye on energy prices and diversify your investments to mitigate risks. Thank you.